Hey everyone, it's Imran from Options Insight, back with another macro option spotlight. Okay, US stocks saw some more selling pressure with weaker ISM manufacturing PMI data out of the US and more hawkish rhetoric out of the likes of Kashkari from the Fed. So we saw S&P down small, Nasdaq down a bit worse, but we did see that strong rebound out of China, 4% move in FXI to the upside, which is a 2 sigma move. And then European markets were a bit lackluster, drifting lower as well. Commodities wise, we did see a bounce, obviously helped by the China news. So broad based there, with the likes of copper back, well above $4. But we are seeing a little bit of pullback overnight on weaker risk sentiment. So wouldn't say the commodities are out of the woods just yet, although they have had a bit of a bounce from the lows. So we'll see how that plays out and if that turns into something real. Equity vol wise, we did see a bit of a bid come back to Nasdaq and S&P vol, but the moves are fairly muted, so nothing too significant there. European vol in DAX and Eurostoxx also catching a slight bid. Positive carry still, we can see across all those US and European indices there. Realized vol kind of trekking lower as we aren't really accelerating to the downside as these levels, as we're testing support levels, but we're not really breaking them in a meaningful way. Skew in general has been working its way down. Obviously, we saw a big pop over the last few weeks, took it to like 50th percentile type levels. And you can see now it's coming down to around 25 percentile kind of range. So still a little bit elevated from the low levels that we saw early in the year. But skew giving some of that back. We do think, to get skew to go back up again significantly, we would need to see consistently larger moves in spot and vol to really justify that skew being where it is. Okay. And then commodity skew, we are seeing that softening a little bit as a bit of upside buying starts to get going in the likes of oil and copper. You see copper skew flipping to 1.3. That's call premium now. So clearly that bounce in copper and the China news has got a few people excited, maybe looking at upside plays in copper. Okay, moving on to the charts. If you look here, S&P at this very key level, 39.50, and just below that 200-day moving average now. So the question really is, have we broken trend again and are we headed lower? Clearly, we know there's a bit of CTA selling that needs to be done down here. That's going to keep a lid on the market. Tesla stock was also down 5% after hours as their investor day gave nothing to the bulls. So we did see a knee-jerk lower down to 39.20, 39.30 area. But really, when the US market comes in, we're going to see if we're going to get close below those levels to really determine what happens next. Now, the put wall down at 3,900 is kind of the area of the last line in the sand, I would say. So obviously, technically, it doesn't look good that we're breaking 39.50, but 3,900 really is the area that needs to hold. If we break below there, then a quick slide to 3,800 starts to look much more likely. So kind of keep that in mind. If we do head down towards 3,900 and we see that put selling come back in and more monetization of hedges, like what we've been talking about over the last few days, we saw that skew come back down. We think there has been some monetization. We continue to see that into weakness in the market. That's going to be at the margin bullish. However, if we go down and we see that put wall shift lower, that opens up a load more downside and things could take a turn for the worst. Now, another key factor to consider is rates vol. The MOVE index has been driving things yet again. So obviously it did come off early in the year, but look at that bounce there in the MOVE. And we see clearly a bounce in the MOVE means a slide in the market. And that correlation between the S&P and the MOVE has been in place for quite some time, since like half of last year from the summer. So really, if the MOVE keeps charging higher, it's going to be pretty hard for the S&P to hold on. Now, that break in 4% yields is going to make it difficult for a quick normalization in rates vol, because people are a little bit nervous here with rates breaking above 4% again. So we do think vols are going to stay high, at least in rates, until non-farm payrolls, which happens next Friday, if not March FOMC, which happens on the 22nd. So, I don't think we're going to get that normalization that quick, which means it's going to be hard for the S&P to really bounce materially before then. And then, we do see scope, though, if that 3,900 area holds, that put wall area, if we touch that this week and it holds, we don't get a shocker out of ISM services, then there is room for a bounce into non-farms. But think of it as a tactical bounce only, and I wouldn't get attached to any long positions if it does work out, because all hell can still break loose on non-farms and some of the inflation data that's coming in the next couple of weeks. All right. Now looking at something on our radar is copper right now. We have mentioned that copper needed to hold that $4 level. It had a little push below it, but has bounced pretty strongly. But if you look how copper and the metals and mining index, XME, how they've been trading since October last year, they've kind of been moving in lockstep. And you see that in these green and orange lines, right? So copper's the orange, but basically it's been carving out a bit of a triangle pattern, a consolidation pattern, still within an uptrend, and now it's testing the top of that. So both XME and copper trying to test the top of this this kind of triangle formation. If it was to break above that, then that would probably be game on for a lot more upside in copper, right? The structural story obviously still remains good. The China PMIs came in with a beat, which kind of helped this rally. So we know that the story is good fundamentally on the long term. But if you look at where the chart is, and you can see this clearly a resistance area here that we could trade back down off. It looks like copper's trading back down overnight. Also, you've got these inventories. So you've seen copper inventories on COMEX, LME, all rising. And that generally isn't going to be that supportive of price in the short term. So we may need to work off some of these inventories that have been building before we can get that break higher in copper. So right now, I wouldn't be adding longs. I mean, I've got some structural longs in the long-term pension book. I'm not adding to them. I've also got some hedges on as well in the short term on things like Freeport-McMoRan. I'm holding on to those hedges right now as well. So I feel pretty balanced, but just saying that, until you get a conclusive break here, I wouldn't be piling into fresh longs. Now, looking at the volatility side of things, XME vol does, however, look quite cheap. So even though I wouldn't be putting fresh longs on here, if you look at XME on our strategy compass, we're seeing buy puts, but we're seeing, more importantly, we're seeing the low levels of vol. Out of all these sectors, XME, in terms of its percentiles, is screening the most cheap. So maybe if we look at you look at the 2-year volatility, it's pretty much back to its lows going back to end of 2021. So we do think there may be an opportunity here in buying XME vol, not necessarily buying naked calls with a load of delta on them, but buying, if you think there's going to be a correction back down, you could buy puts. If you think there's going to be a breakout, you could buy calls. But if you agree with me and you just think the vol's cheap, then maybe you want to look at 2-month, something like straddles and strangles, which get you long this vol at what looks like quite a nice cheap level. And that way you can benefit from either a break higher that takes this thing materially higher. The likes of Tony Greer have been calling for XME to touch $70 at some point this year. So that's a ton more upside from here, more than, like 20% plus. Whereas if we were to go back down again, there could be some weakness as well. So I think that's the way to play this. I think the implied vol levels are probably a bit too low here. If you park yourself in the 2-month expiry, it gives you time for March FOMC to play out. So you can see what the dollar wants to do on that. It gives you more time for some more China data prints to come out to see if the reopening is really going to take hold. So these are the factors that are really going to help XME decide its next direction. Okay, that's it for today. That's kind of where we see the value. XME implied vols look cheap. We'll be looking at long vol structures there. All right, take care and see you tomorrow.